Okay, welcome back to the live stream. Smarthelping.com here. And let's do a sound check. Sound check. Test. Test. Okay, that works. Good. Test. Um so a couple administrative things. Today I'm gonna hopefully finish the general rental business model or financial model, which is for essentially any business in the rental space um, that's just buying things over time and then renting them out for some amount of money. And it could be equipment rental, heavy equipment, light equipment, furniture, party supplies, basically any kind of good that you have that's just rentable, tangible good. Um, when this is done, I'll probably list it for $45. No, I have had an equipment rental model up for like 3 or 4 years. It's been, well, let's see, the third most popular template downloaded. And so this is a great expansion to that. And uh, the model I'm working on now is more sophisticated. But the concepts are the same for sure. It's just this has got more granularity in the purchases and category types, as well as, and the other thing is I've automated the depreciation, so this will get down to earnings before taxes, and the other one only got to essentially cash flow Ebitda, but it didn't do anything with depreciation. So it's a little bit more, it's a little bit different. Uh, so today the plan is to get the monthly P&L done. I got to get all the Opex through. Um, we've got to get visualizations done, um, the annual summary and all the executive summaries, distribution details, and internal rate of return calculations, all that. So that's the plan for today. Also, note I'm probably changing my stream time for a couple reasons, and I'm gonna try to do it. I'm gonna shoot for Mondays at 5 and see how that goes. I think number one, most of my audience is working 9 to 5 jobs, or in or not necessarily 9 to 5 jobs, but at this time they're likely working as well on Excel stuff. So if I make it later in the day, it might be more accessible to people that are interested in this kind of thing. And number two, sometimes at 9 a.m. I am not as awake as I want to be. So if I move the stream later in the day, I feel like it's just going to be better. So starting next week, we're going to go Monday at 5. And we'll see how that time slot goes. All right. Well, I don't think I got anything else we need to go over. So let's just get into it. I'm going to go kind of fast here because it's just a lot of formatting and P&L stuff. So we're starting here with Opex, and we got our Opex schedule right here. And I think this is all in the same positioning, so I could just do if this is less than our start date of the expense, then 0. Let's see, is that we lined up? Shoot. So this was 2739. Oh, hold on, hold on. This needs to flow down. Okay, perfect. So this is lining up. Great. And the reason why I always stagger and try to change the amounts is just to test to make sure the formula is working. So now that we got those in, we could just do total. Oh, hold on. This is actually sales and marketing. This is also a time where I'm live, where I'm accessible, and I will take suggestions on potential future customizations, or I mean past customizations on past work, or ideas for models to build in the future. Drag this over. So I hope to get down to EBIT today, earnings before taxes, and then I guess we could apply a tax rate to that. Normally I don't go down that far and I don't do automated depreciation, but for the rental business, that's definitely a material thing. All right. So I guess, yeah, we could do that. So this is a percentage of revenue. Sales and marketing, just label these so it's real clear. R&D. This is usually credit card fees here. But it could be anything, just some cost as a percentage of revenue to try to catch all if there's something else. So then we got total operating expenses. Now, sometimes, so with rental, you might do an expense as a percentage of like the value of the equipment. But I've done a granular job here on the fixed expenses, so I think this is good enough to catch any like ongoing maintenance and repairs of the stuff you're renting out, whatever it might be. And I'm sure there's enough granularity here to make that work. But if you wanted to, we've got the cumulative purchases, the cumulative purchase dollar value over time. So you can see that number, like the total you've spent. Um, we've also got depreciation all the way down here. And net book value, which we'll get into later. All right, so operating expenses. Go Ebitda, which is just net operating income. Revenue. There's not really cost of goods sold necessarily in the rental business model, because you're renting things out. There could be, and if you were, you'd probably account for that in this section of the cost schedule. All right, so Ebitda, you can see kind of as you build up, you start to cover your costs more and more, and then you start to become profitable. Now, obviously, the assumptions I put in are random, arbitrary, but I just kind of put generally fixed expenses, and you've got more revenue coming in as you start to purchase more things that you can rent out. All right, so Ebitda is here. We're gonna have to do some kind of financing. For debt, we're gonna assume only one loan right at the beginning. Let me. So usually what I do here is pull up debt schedule from a different model. Put this in here. Now, I know you could do a bunch of, for the rental business, a bunch of different loans. This is going to equal that. You put your terms in here. But there's so much, that could be so many different values. Round up. We want to do 12 divided by that. So I'm just counting it as like one initial amount that you might want to finance. Um, and if there's future capex that's like, if you plan to do like a giant tranche in like 3 years after you've already become profitable, then that's gonna have to come out of equity if there hasn't been enough cash saved up. Make sure this works. So if it's 4 payments a year, that should be three. Yep. One. Oh, nope. Payments per year, four. Yeah, that's right. So 1, 2, 3, 4. 1, 2, 3. Okay, so let's bring our debt in. Like on the original equipment rental, I did up to 5 loans over time, but I don't feel like that was super helpful compared to just doing one at the beginning. Once we finish all this, we can do some uh, visualizations. That'll probably be the longest part of this stream once I get to it. So you got that, then we want to pull this into cash flow. So you got debt funding and debt repayment upon exit. So this is 1 month delay, so this equals that. Then we'll do, so we know our debt funding amount, we want to do our debt balance as well. So we go, it would be, best way I figured out to do this is just take this minus the sum of any principal payments. Reason being, if it starts in a future month, it will work. Actually, we can pull this over here. What's going on, guys? Okay, and I think that should work. Let's try and change this back to 12 payments a year, and let's say if this is a future month. Perfect. So that comes in month 3. First payment date comes in there. Yep, that works. Debt funding. Perfect. Actually, we're gonna have to do if it's less than over 1, so we don't overrun the model. Perfect. That, and then so if this equals the exit month, then pay off the remaining debt, which would be this. What's going on, viewers? We're just plugging away here, just trying to pump out this model. It's the 3rd week, and I want to get it done today, so we're going to be here till it's done. Make sure this works. So this is just zeroing out anything after the exit month. That doesn't matter. Okay. All right, so we got debt service, all the debt stuff happening. So EBITDA is obviously before interest, tax, depreciation, amortization. Now we've got interest and depreciation happening all on an automated schedule. So what we do, let's pull these up, is let's now get down to earnings before taxes. So to do that, we have to reduce interest and depreciation off of here. So this is going to be your EBITDA minus interest, not the principal, minus depreciation expense. Because depreciation is a non-cash item. And the actual cash that went out for that will be accounted for in the purchases, which is up here. Total purchases of units each month. So these purchases here, as they happen, then start to make depreciation happen as an expense, and the expenses where they're deducted from taxable income, not when they're purchased. Because 9 times out of 10, if you're renting stuff out, when you buy it, it's going to have, you can't expense it all at once. It's going to have a useful life, and you got to depreciate it over time. So before taxes. That's definitely a major line item. And then, so, yeah, I guess that can just fit in there. And now when we do taxes, which we're going to do, we'll have to do that on the annual tab to figure out if the year was profitable, if we want to figure out taxes. That'll be later in the model. We also have to get in here. Let's see, net book value is going to be all the way at the bottom of this. We have to do other startup costs outside of purchases of inventory or whatever we're renting. So like if you do a website or something, anything that's just not accounted for anywhere else where you got to spend money to start up the business. That's accounted for right here. Now, as far as taxes go on startup costs, usually they're tax deductible, but this is getting into the weeds a bit as far as like this is more of what CPA is going to have to figure out manually when they do the startup taxes. But for the purpose of this, we're at least listing them here, and then they'll count towards cash flow, but it's not going to affect taxes for this purpose. And then we've got, let's do the same, well, then we've got CapEx outside of obviously buying all the stuff that it's renting out. So CapEx stuff is potential one-time future expenditures in this model, or it's where you're going to account for it. Like if you were going to do expansion of office, buildings or just some future expense. So you can account for that here. This is also not going to have any tax effect. We're just doing cash flow effects for CapEx and startup costs. All right, that's working. So now so we'll have taxes here, then we'll have net income after taxes. That'll be top and the thick bottom. We could probably put a profit margin in there. But we can't do that until we can populate taxes. So we've got our net income. Now when we actually go to cash flow, this is where it gets a little tricky. So we do, it's Ebitda minus all the debt service, uh, plus any debt funding. And this is how we figure out how much equity or owner's cash is going to be needed for the startup. plus that minus taxes minus startup costs minus capex. And let's put this back to the first month. So, and then cumulative cash position. Now this here is going to be how you figure out how much your minimum cash requirement is. It's the minimum of the cumulative cash flow. Which in this case, it accounts every single aspect of the actual monthly cash flow. Oh, so what we actually do need to do here is subtract out the purchases. So this is going to be this number here. And we're not doing the depreciation expense for cash flow. We're just doing purchases. Okay. So if we go then back to here and say remaining equity required after the debt funding is just the negative of the minimum value of all this. And technically, if this number is less than 0, then it's 0. Because then it's saying you don't need any, you have a surplus of cash after debt. And that would basically mean you're funding everything through debt. Let's say I did this like $1 million. Then my remaining equity goes to 0. In this case, it's not, let's just say it's 250,000. So there's the remaining equity. Then we have how much the investor contributes and how much they get for that. And then implied valuation. And then owners would have to come up with the rest because there's no other sources of cash at that point. Let's put investors up at like 400. All right. So that's all we need here. We'll probably put our tax rate. Let's put the corporate tax rate here. Corporate income taxes. Now, if you don't want to account for taxes at all, which I understand why not, then you can just zero this out. All right, so I believe we've got, let me just double check our formula here. So we're doing, wait, we're doing total purchases plus Ebitda, which is basically all your operations. Then minusing total debt service, adding any funding, reducing out taxes. And then our net income is just simply this EBIT minus any taxes paid. profit margin is just net income divided by revenue. Give that an italicize. Also, I want to make this, yeah, let's make this a little bit better standing out. Yeah, we'll have some cool metrics here with some of the stats we got calculated, I believe. Okay, cash flow, net book value is just kind of, it's a number there. It's not, I'll probably use it for some visualizations because it's essentially saying your net purchases against your depreciation, what you've depreciated from that. All right, we're making good progress here. Um, let's see. So cash flow. What else do we need to do here before we get to annual? Trying to make sure I just got everything. So this is all revenue. This is the most complex part of it, is the revenue assumptions and depreciation. You can see we had to do a whole bunch of matrix tabs for all of this to get it right. Ebitda should be darker colored. Ebitda, debt service, EBIT. Well, I guess we could probably, oh, exit value. So let's look at some rules of thumb on the valuation of rental businesses. We'll just do equipment rental for this purpose because it's most popular, probably. Let's do valuation, actually. I've got a couple books on this from 2016 that are nice references, but they're getting kind of old, so let's see, the 1% rule is simply a rule of thumb that says a rental prop. Oh no, we're not doing rental property. Let's try valuing equipment rental business. I know it's going to be something like, usually it's a percentage of, or a multiple of EBITDA or a percentage of revenue. But like with the lending business, it was really just your net assets. So I'm just making sure this is nothing. Okay, so equipment rental companies 0.4 times gross revenue, net sales. Okay, so it looks like the most common thing for that is a percentage of sales. So that's what we're going to do. So exit multiple, yep, annualized revenue month of the sale. So the month of exit, we're gonna take the trailing 12-month revenue, trailing 12-month total revenue. So we'll take November and then 11 months before that to figure out the annualized revenue. And then whatever the multiple is, it'll give you exit value. Now this is always a little tricky because how do we know what the 12 months trail, what are the 12 months trailing the actual exit month. And so I have a formula for this. I can't remember it exactly, so we're going to pull it from one of my other models. I think it should be in a more recent one. Pretty sure it's in this one. Ad network for sure. There we go. Yep. Trailing 12 months reference row. Okay, so this is what we want. And it's just based on the date and the control start and month. So E4, let's make sure this is the right date. C5, yep. So now it should give us our exit. There we go, perfect. So C1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So whatever exit month is, it's going to take those 12 months. So if we put it to the last month, it's here. If we do NA, it's just going to be nothing, and that's fine. All right, so we have this. Now we just do our exit value. So where do we want to put exit? I guess we'll put it right above the final cash flow. Terminal value. And what the terminal value really is doing is saying what is the value of the business after whenever your model ends, because you're not going to just build the model forever. So putting the terminal value there is a way to value the future cash flows without doing an indefinite model forever. So our revenue is up here. Sum this if this is 1, our reference row. And then we'll multiply that by whatever multiples in the control tab. So this, and then we just do times this multiple. And we only do that if this equals the exit month. And then that's obviously part of cash flow as an addition. Make these a little bit wider. Okay. Now I think we have everything to get into the annual P&L, and then we could be getting closer to finishing. So 5 years, 1, 2, 3, 4, 5. this. Don't need this. Oh, wait, this is actually going to be the year number down here. So this is mostly going to be a sum ifs of all this. So this, if the year matches the year. And this is saying everything's purchased. Oh, no, we got slowly or eventually get to 0. Now we're going to want to lock E3. So we can drag it around. We're going to want to lock this as well. What we don't want to lock or do or don't is the actual row that we're summing up, because that's going to flow in the same order. So that cumulative actually works fine, that formula. This should be a dollar value. So we purchased a total of $80,000 worth of units based on how much we can rent it out for. Rental fees by category and our expected utilization of what we have to rent out. We then make this revenue. Let's make sure this adds up. So 79.8, 4375, 4375. Yep. All right. So rentable units is, let's think of the best way to do this. I guess it would be, this is an index formula because we just want the value at the end of the year. So index this if this comma 11 matches our month. That should give us the rentable units at the end of each year. Okay, lock, drag, go down. Now 2222, is that what we end at? Make sure, no, hold on here. We end at 3409, so what? Technically I should just be pulling all these, so let's see. What am I missing? Oh, this has got to be 12 months, not 1 month. 3409. Perfect, 3409. Units fully rented out per month. Now this is a number, I think we also reference the end. This is based on utilization, so 2573. Yep, perfect. Now we're probably going to need our sums here for, yep, for revenue per year, per category. And make a solid line. So go to format, line style, solid, bottom. revenue. So average monthly rent. So this is now going to be annual. Oh, I think, but hold on. Average monthly rental revenue. Yeah, I guess this is an average. I mean, it's really not super precise because unless you bought everything right in the first month or first few months. But right now we have staggered buys like every month, so this is going to be a little bit of a rough average, but it's fine. Average annual rental unit. Yeah. And this will be lower than what it actually is for the month. So the monthly is 95. If you go the first 12 months, 1, 2, 3. I mean, that's actually way higher. $127 per month. We're saying this is per year. I guess that's right because we're using the end units. I mean, really, it's. I don't even think we should probably do these on an annual basis. It's just so going to be so different. Yeah, we're not even going to put these on an annual basis because it's just there's too much variation potential. So we'll just do the average monthly. This is perfectly accurate here. These numbers. And what? Oh, and what these are doing is actually this is an interesting calculation. So for rental, this is saying what's your average based on this revenue and the utilization, how much are you making per unit per month? And so if the utilization is 100%, then these numbers are the same. But because it's not, you're actually the revenue based on what's actually rented is this. But this number is also interesting because this is a number you could apply to all your inventory and say, well, I might not be renting it all out or utilizing it all is it for its maximum potential. But assuming if it were the revenue I am getting from what's rented out, if you spread it out, essentially you're making, in this case, month one, $8 per unit that you purchase per month. So I thought that was an interesting calculation to have in there. Okay, Opex. This is easy. Just dragging it up or down. And then we'll make sure our cash flow matches at the very end, and that will confirm everything's correct. Usually, if you were to purchase a template, when you go to start filling it out, I would suggest going through and zeroing out all the light yellow cells and then starting with your own assumptions. That's how it's to be used. What is going on here? Oh, this can just be a sum. Make sure these are right. Sum. Okay, so Ebitda 6,149,000 over 5 years. This needs to be a sum. Glad I caught that. And Ebitda here, 6,149,022. 6,149,020. Well, this is rounding. 2267.23. That's the same number. Debt service. You sum it up. Debt balance. Yeah, that makes sense. Now, debt funding, we do, so this is a little tricky. So for this, we just make this equal the first month if there is anything. Otherwise, sum. So if we go into month 2, perfect, then it goes over here. All right, payment, depreciation expense, just drag it down. Now we get into, this is essentially your taxable income, which is all your EBITDA minus interest minus depreciation. So we do taxes, we simply go if this is greater than 0, then take that times tax rate of this, whatever it might be. I just put in a random number. And if it's not greater than 0, then there's no taxes for the year because your taxable income is negative. That's all fine and dandy, and then this should all flow. Oh wait, we need to do sum ifs for the capex. And terminal value. Okay, so we get to, well, actually, we're gonna have to put the taxes into the monthly to match. So taxes are kind of tricky when you start to like have an end month that's not the last month of the year. Let's say it's October of 2025. So just to make sure it works how it needs to, um, so we know this is the tax rate for the year based on whatever EBIT is. Because this is separating out, we also need to put taxes and selling fees on the exit value. So what we do is we say, so the exit value is this. Just sum up that. Come on, Excel, don't die on me. Oh, don't do this now, please don't. Sometimes they'll do this when you reference something on another page, it'll like completely stall out. I really don't know when the last time I saved was either, so let's just pray. Come on. Okay, I've never had it last this long before. I literally can't do anything and I don't want to exit this out. Whew, okay, thank goodness. Alright, so exit value I'm saving right now. That was weird. So we want to actually say, if that's exit value, then we want to say taxes, selling fees, etc. as some percentage. And this could go right here. Let's say it's, I don't know. It'll depend. Let's just put 15% for everything. So the net exit value is just this times 1 minus this. And let's put a space here. Okay. And let's make sure it works. If we did no exit, yep, perfect. So 4.7. So we actually, on this, we got terminal value and then net terminal value, which just equals, if this equals this, then take this value. And notice we don't have any circular reference issues because we're going straight down the waterfall like we need to be, and no calculation is referencing itself. So actually, we want this, we want to sum up the second number. And then here, do annual, and this is just because we're not doing taxes. I don't want to put the taxes and EBIT rate in the same thing. I'd rather separate it out, so the easiest way is to do a terminal value and then net terminal and take account for taxes and stuff within that. So this is just another sum ifs, and reference this value instead. Okay, so now we actually have completed all our monthly and annual cash flows. I don't need this. This is going to be another index. And now we're going to do visualizations. Well, first we're going to do distribution, contribution, and discounted cash flow analysis, and then here it is. And then we'll get into visualizations after that. So this should give me the net book value at the end of each year, which is just purchases less depreciation, cumulative depreciation. All right, so 38,648, that should match, which it does. Now I guess technically these 2 months, so let's see, where's this calculation coming from? Depreciation tabs. So let's go up here, and this is the fun part. So we got to count for that exit month potentially not being the last month. So if this is less than the exit month, we've got to put this on all the calculations now. Then 0. I'm sorry, if this is greater than. And lock this, even though it doesn't really matter. So now we just drag these over. Well, that's already 0, and this is already 0 actually because we stopped purchasing units earlier, but if we didn't, this would force it to stop at the exit month. Oh no. Okay, so undo that. So I was worried about. So question is why can't I drag that down? Ah, because this needs to be locked. C5. All right, I think it should be fine now. That looks good. 21, 19, 18. Okay, good. So that's fine. on this because this is referencing above. So if it's 0, it'll just 0 out. Definitely need it for this. Div error, so let's do if error 0. Nobody likes to see div errors, even if it doesn't matter. So I try to cover them if I can. Now, this part, yeah, I think I can drag it just within each expense category. I just can't go below. I just have to repaste it now on this one. And then these are based on revenue, so that should automatically 0. Okay, depreciation expense is still got a value there. However, yeah, it's still going down. Shoot. So obviously there's no depreciation expense when we stop operations. The only thing that's really affected here is these two. So what if we just put it in here, zero it out? Because we don't care anything about the after the exit. So yeah, that's just going to be 0 and this as well. Okay. Great, so that's done. Let's think about taxes on operating income now. So we need to know the only tricky thing about this is if the exit month is a partial year, that means that the total taxes for the year need to be spread out over less months. So what we have to do is on the monthly, say active, and then as long as this is less than or equal to the exit, then 1, otherwise 0. And we drag this over, and now, and then we sum up, watch this, so total, so active months per year. We do sum ifs, the row above it, if the year matches. If the year is the same as the year of that month. So you see it's going to be 12 and then 10 in the last year. So now you can see what we're going to do for taxes for the monthly is do sum ifs the annual taxes here if the year in 3 matches the year here. And then we're going to divide that number by the number of active months in that year. So obviously year one, we have an operating loss, so there's no taxes. And most startups in their first year are likely not to have taxes. It depends though. You could. It depends if you're profitable or not in that time. So we do in year two, and then we go over, you can see, now hold on here. So that we don't want. So if this, so we can also do this thing on here. If E289 is equal to 0, then 0 it out. And then that's fine. Div error, we just do if error. And I always like to the div error I like to fix on the actual calculation that's causing it instead of trying to put it on every single one. So there, and now 602,302 for taxes over 5 years, and 602,302 same amount. It's perfect. So we have all our operations happening there, net income, capex, net terminal value after taxes and selling fees on that, and we see a cash flow which takes into account everything else, and you end up at 9,432,870. 9,432,000, and this is your check here. This should always equal this. Okay, great. Now, all the hard stuff is done. Now the fun stuff is summarizing. So these are like the monthly details I like to always have so you can really dive into stuff. But if you just want to see high level numbers, we're going to add a distribution tab for basically what the project produces in cash flow and what it requires, and then if that's split between investors and owners, what's the splits and what's the discounted cash flows of all that. So distributions, then we're going to do executive summary, which is just the project level financials at a high level. And we have these formats here. So we can do similar stuff, just change the references. So this is always good. Usually in all my models, the revenue and expense logic is going to be pretty unique, but the summarization of what happened is usually pretty similar, like the shell of everything. So you've got, the executive summary is going to be, you got revenue, costs, operating expenses, Ebitda. In this model, we're going to drive down a little bit further because we have taxes. So we're going to have net income after taxes, distributions. Same thing that goes on every model that's going to be relevant. And I can't tell you how much time and effort went into figuring out this distribution contribution logic to make sure there's no reference errors, circular references, and it actually tells you the right numbers. One of the hardest things in forecasting is if you've got negative cash flows for some of the months and positive and negative and back and forth, the figuring out how much is actually available to distribute versus how much is needed in equity is not easy, and that's why you can see this logic happens to make sure we get the right numbers and we don't double count or miss anything. Okay, so we'll do distributions first because that's harder. So total cash returns. This is going to be what the net cash flow is on a monthly basis if it's positive. We go all the way down. We don't care about net income for this because we want cash flow. So some of this, if this is greater than 0 and the year matches. So this does include the exit, if you'll take note of that. Can't forget the references here. That's fine, okay. Now this is going to be the same calculation, but if it's less than 0 instead of greater. So we flip the sign. So you've essentially now shown, okay, for each year, here's my total of all the positive months of cash flow. Here's the total of all the negative months of cash flow for each year. Then we know that, well, how much equity do we have remaining after year 0, startup costs and all that is accounted for, and debt proceeds. So here we add up. So I do the monthly plus C12, which would be remaining equity. It's one off on here because I pulled that down. So here we're saying the total equity contributed plus the monthly cash flow for that period. 746. Then this is going to just be the total equity contributed. So the difference here is just going to be the difference in the month 0 cash flows, which is just your startup costs, your debt proceeds less any startup costs. So it could be, the net of these could be positive or negative. Doesn't matter. And then this is just the same thing, equity. And then that's it. So you can see here, all the equity requirements we think we're going to need are up front. And then if we start making positive cash flows, that'll flow through here. If for whatever reason there is a negative cash flow year, or even, well, yeah, if there's a year where there's more cash outlays than returns for whatever reason, this will account for that perfectly fine, and it will actually pull from equity, and it will say, well, you've got all your equity to start up, you're running, and then you're going to have a net contribution here, and that will offset against any positive cash flow for the period. But if it's more than this positive cash flow, then it will come down here as a net negative number, summing the two up. And then it'll just be like a project negative cash flow. It assumes equity is going to cover it, and that'll flow here according to the percentages that are defined for how much of the profits investors are getting versus owners. So right now it's 60-40. So that logic to make that work right and make it clean, this took a while to figure out, but now it's really good. I use it on all the models. It's great. Okay, so project level internal rate of return is this. Discounted cash flow here based on 10%. You could obviously, let's make this a better color. Now this is investors share. Do that. That's fine. So the investor and owners IRR always should be, one should be above, one should be below the project internal rate of return. So here we can see investors is at 90, owners is at 87. So that's not right. Obviously, something's wrong there, and it's because we still have some references to the other model. So this is owners equity here. This is investors Now we go. Okay, so 70 on the investors, 96 owners, and that's always, then the project is in between those. So that's one kind of small check to make sure it's right. Also, if you plugged in this internal rate of return to the discounted cash flow percentage, this net present value should always be 0, which is the definition of internal rate of return. That's telling you what you have to discount the future cash flows at so that they equal the value of your initial investment. So that's another check you can do to make sure. This is all good. We'll reference this to our actual workbook that we have here. Owner. Got to get rid of all the references to the other workbook. Okay, that looks perfect. So there's our cash distribution and that visual. Executive summary is next. Now this we're going to have to do some modifications to. First, fix the year. All right, so year-end publish. So this is like the top level main important number. I think that should be cumulative purchases, I guess. This is telling you how much you've bought to rent out over time. Then you got revenue. It's a simple reference. Cost of goods sold, we're not really doing in this model because you're renting stuff out. You're not buying and selling. So gross profit is just going to be the same. Now we go G&A, which is, we label it here. That sales and marketing. Research and development. Now it's important to note when you're using this model, you can definitely zero out things that are not relevant and kind of tweak it. And that's why there's so many different input cells and variation in the logic. It's so that the model can be very versatile and fit basically any kind of situation you're trying to model. Okay, so we've got Ebitda now, other cash flow items. I'm actually just going to clear this out and just redo this. So this and this will have to be redone as well. So we've got debt service, net funding and repayment. We've got trying to think here. Don't need depreciation, taxes. Startup costs. CapEx. Net terminal value. And now we can just drag these over and it should match right up from the annual. We'll put this as just CapEx. And then I'm also going to put, well, no, it's not. So, so we do Ebitda. minus debt service plus funding, minus debt repayment, minus taxes, minus startup costs, minus this, plus this. Now my question, why is terminal value, oh, whoops, we are on the, wait, what? How did this get to the monthly? Okay, net terminal value should be right there. Cash position 13, which this should equal this. It does not, so we're obviously missing some stuff here. Also, I want to show Ebitda. I also want to just show the net income here, which is going to be Ebitda minus interest, which we'll have to get from the annual, and then minus taxes. We're not doing year 0, so this should equal 8621. 49. Okay, so we are definitely missing. Oh, and minus depreciation. So net income has to reduce that non-cash item out. Although it still seems so 8581 is high. We're at 5. So we're missing something. Let's see. This is why we always do these sanity checks. So let's check Ebitda first. So that's 9264. Make sure that matches this. No. Okay, so we're definitely we're missing something here. Oh, probably these expenses percentage of revenue. So those need to be in. Put it right here. Other expenses percentage of revenue. I knew we were off by, it had to be something like that. Big item. So this. Okay, now we're at 5679. 5679. Now I think we're good. Give this a color shade. Okay, put the percentage in there, which we already know what it is because it's actually defined in the other tab, 15, 19, 23. You can see here, 15, 19, 23. So those percentages will always equal the total of all these, assuming the start month is applicable. Like if you don't start one of these till way later, then obviously the percentages aren't going to be exact with the percentage of total revenue. All right, total expenses here. Now net income. Do give that a top and double as well. So 4996. What do we got here? 4985. We're off by 10,000 somehow. So let's see, 447 for the first year. Okay, we're off in the first year and the second. 113. Wait, 113, 160. So Ebitda. Let's just go through the calculation on annual. This is taking Ebitda minus interest, minus depreciation expense, and then minus taxes. So we should see the same thing here. Ebitda minus interest minus depreciation expense minus taxes. And we're not doing anything with terminal value. Oh, somehow I must. So what was I referencing? 222, 231, 228. It's the same. Oh, I was off by a letter, looks like. Okay, so now net income 4985. 4985, perfect. We have all of this. Then we have cash flow after equity. So this is still off 9523. And it should be 9432. So we're off by like over 100,000. Trying to think what we could be missing. Let's check here. So 250. This is at 10, so that's one issue. Why are these off? This should be D. Yep. So startup costs are 0. That should not be. Should be equal to this. D252. What did I have it equaling? D235. The heck was that? 235. Oh, I put equal to this. Okay, that explains that. Now, oh, we're still out. So 10,000, I think that matches the first year. Next, 689.4. Okay, so this is off. Let's see, debt service 15,201. Yep. 435, 173. Yep. And then CapEx 235. Yep. So 689.4. And we've got 673.3. Make sure we did all our signs right. What's up, viewer? Trying to figure out where in the world of cash flow, equity, after equity. No, this is actually just cash flow. Before equity. Oh, these are the fun ones here. What are we missing? I guess let's just redo the calculation. This minus this plus this minus this minus 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 plus. Okay, what's the difference? Let's see here. This minus 16,100. All right, what in the world is 16,100 that we're missing? And is this number lower? Is this a 689, 670? Okay, so it's on here somewhere. 16, 1. It's not any of this. Oh shoot. The purchases of the what we're renting out. All right. That's a big one. We'll put that at the top. Total purchases equals up top here. And because you got to buy stuff that you're going to rent out. So minus this. There we go. What? We're still off? So 6204, 156. What? 9432. What am I off? 9204. Oh dear. So this, what are we out? 228,000. Okay. What could that possibly be? And this is smaller, I'm assuming. Yeah. So, I know it's not this difference because that's millions and we're only out by 200,000. Let's just go, so year by year. So 10, that matches. No, wait, wait. This is 6 million, 6,100. And we're at 10. Oh, for goodness sakes. I was, okay, so I started in year 0. Purchases obviously start in year 1. Oh man, we're getting, we're an hour and 37 minutes in and I'm feeling it. And we're still out? Okay, 10,000. This is 689.4. That's right. 59,056. Yep. 1,159,000. Yep. 1947. 6945. Okay, so that we're out by that amount. Yeah, 228. So something in the last year. Oh, debt repayment. So definitely is accounted for here. Did we not calculate it in the annual and monthly, apparently? Yes, I missed it. Yep, sure did. So minus debt repayment. And this is why we do all these checks. So now 9204, let's fix the monthly as well. Minus debt repayment. 9204, 156. 9204, 156. 9204, 156. All right, guys, we're getting there. We are getting there. What was I about to do? Oh, distribution's a little bit different, but so this number 9,940,000 should equal something. If we calculate, or no, all of it, 9204, 156. Okay, so that matches 9204. Perfect. So everything matches up. You'll be able to put in anything in these control and assumption tabs, and it will flow through here perfectly. No issue. All right, now let's re-reference all of this. So project IRR is that. Equity required is for the whole project this. Sum 9. There's your equity multiple on the project. ROI, investors, same thing. Internal rate of return, investment of investors. Cash returned is their distributions. Owners, IRR is 95. Required equity is here. Cash returned is here. Now, obviously, if the owners don't contribute anything or just a small amount, like you just like increase this. So let's say this is 750,000. Well, now that's more. You only need 736. So, like, if you just say investors contribute everything else, then owners is zero. Investors, obviously, you're going to get some still, and owners will get some of the proceeds. In that case, though, if owners are not contributing anything, they don't have an internal rate of return because they have no initial investment, but they obviously have cash being returned based on whatever the percentage split is. And this is just a basic percentage split. I also do, if you, first of all, if you're this far into the video, congratulations. Um, if you're this far and you're hearing this, I'm actually going to give you a huge discount. If you're this far, I will give you 50% off of anything you buy on my site. 50% off. And that's because I don't think many people get this far. So if you did, you're in luck. Just reference the video. It's 10:42 a.m. on June 15, 2021. Okay. Now what was I going to say? We don't need this anymore. Uh, what was I doing? Distributions. Oh, right. So I also do joint venture models that are just assuming you have like this project cash flow, you can plug that in to any of these joint venture models and get, if you want to do like internal rate of return hurdles or preferred equity or all kinds of different things with the cash distributions besides just a set split, these templates in the joint venture tab are for that. And you would just take the output of the cash flow per year of the models and then plug it into there, and it will give you the splits accordingly. Okay, distributions executive summary. So we did that. We didn't need to update this. So total revenue is obviously the top line here. By year. Ebitda. And actually, I don't know if I should do net income. Ebitda is like kind of the cash, operating cash flow. Net income is doing the depreciation. I think, yeah, maybe we do both. Hold on, let me add this. So we did Ebitda. Let's also do net income on this one. Put in the legend. Oh, what happened to the title? Ebitda net income. Give us a different color here. I want that. And this is going to be light green. Do some borders. All right. Okay, extend these out a little bit. I'm really happy with the whole model. It's great. These revenue assumptions for the rental business side of it are super granular and sophisticated. I feel like we've made some big improvements here for the general rental business model, financial model. I will. So, if you buy this one or my general equipment rental model, this is another gem if you're listening this far. I will give you both. So no matter which one you buy, the equipment rental one, if you buy that for 45, I'll also throw in this general one, or if you buy this one, I'll also throw in the other one. Just ask. If you don't ask, um, I don't know. I guess I could include both in all the emails I send out. Um, it's just more work for me to do too, though. The point is, you're entitled to both. Just ask about it. Otherwise, whatever one you buy, I'll send only that one to you. Okay. Let's do some visuals now, because I'm probably gonna title this something about visualizations live, and we finally got to that after, well, it's been an hour and 47 minutes, but that's okay. Um, so a couple of visuals I definitely know I want. Let's do monthly. We'll do cumulative purchases number. That's a good one. Kind of shows the ramp up. So we can do cumulative purchases, and then on the offset or on the we'll do combo that with revenue, so you can see like how much you're purchasing and then how much you're making over time. That's probably a good one. Put our dates in. Now the charting and the key metrics are where, I feel like I'm really gonna be making waves in the industry because I'll probably figure out or do things that might not most commonly be tracked, but it could be useful for management to make decisions and hit targets and all that. All right, I don't like that chart type though. We're gonna do it's not a stacked line. It needs to be just two separate. Actually, no, we need to combo this because they're different values. So revenue can go on the left, the right. Nope, this one's gonna have to go. Make this one align with markers. Perfect. And this one can be a bar. There we go. Let's add our chart title, legend. I always love doing this. This is really where I'm trying to add tons of value. Obviously, all the assumptions, the layout, the logic, the math, getting the numbers right, that's super important. But this part is, for me, fun. I like doing this and just, I like this part. So this is revenue versus total purchase units. So obviously, as you buy things over time, your revenue should be going up. So this is your cumulative purchases. Now there's a whole bunch of different factors going on here. So even though your purchases stop here, so you're ramping, 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 you're now still making increases each year in your efficiency based on percentage utilization. Now let's say it was just fixed. You said, well, based on everything I buy, I think I'll be able to rent out 75% of it all the time. And let's say revenue is the same each year for each category. Then if we go to this now, you can see we ramp up, revenue goes up. And now why is revenue dropping? Well, the reason is we have this monthly loss rate of furniture or whatever. I'm just going to put units now because this could be used for furniture rental. It could be used for anything though. So I'm trying to at first put this as unit utilization. At first it was just going to be for furniture, but I realized, I mean, this literally could be used for any rental business for like product rental. And I thought the categories were a really good way to give you averages and tranches of purchases of those categories over time, and just give those average rental fees you're charging in different utilizations. That seemed to me like the best way to structure this to give super granularity. And um, okay, so now, so what was I adjusting? Right, okay, so that goes down because of this percentage. If we put this at, let's just say, so we start purchasing things, or stop in January 2023. Just for fun, I mean, I don't know, do I really want to? So we could say this starts in like here, and then we can go December, and then this is going to be down here, June, July 2024. I just want to show you what happens when you like buy for the whole period. So now we're going into 2025. Let's just put this one in 2025 as well. So now if we go to this, you can see, okay, we are ramping. We're continuing to buy more and more things that we're going to rent out. We're scaling up. Um, so now you can see the revenue is continually rising with the cumulative purchases. Now I wonder what else would be interesting here. So we got cumulative purchases. Do I have rentable units? That's a good one too. So let's put in their rentable units in this visualization as well. So if we do, that's going to show you the effect of the percentage degradation of the of whatever you're renting out over time. Like if you buy 10 chairs, maybe after a while you only have 9 of those chairs left to rent, and 8, and it goes down because things break, etc. Um, so we've got cumulative purchases, total revenue. Let's add in. This is actually what's rented out. We'll do that in a different chart. Rentable units. I think this is a nice number to have here. Yes, perfect. And then let's make sure our monthly timeline is on the correct. So that is E. And let's drag this out to the last month of the year. Okay. Very cool. So now we actually see here's the cumulative amount of purchases, and then here of those purchases accumulated, here's what's actually available to rent. So that little percentage gap there is going to be a function of this 0.5. If we put this to 0, then the lines will be exactly the same. As you can see here, now they're the same. But I don't think that's accurate. I think you need to account for the fact that some of the inventory you initially buy is going to, you're just going to have wear and tear on over time. You won't be able to use 100% of it the whole time. All right, let's make this look better. So I always like gray background. Looks nice. I hate this orange. Do like a turquoise here, maybe a blue. And I'm half colorblind, so I'm kind of bad with colors, but let's try here. The markers, I always like to put markers in as diamonds and go about 7. And on the gray background, I like to do the gold fill. Oh, that's the border. Fill, I like to do gold. And then for this, maybe we'll do every 3 months, not every 2. Okay, perfect. And on this one, we'll do the same thing. So markers built in, diamond 7. Fill is this light gold. Border is black. And you know what? It's kind of hard. Let's make these a little bit smaller because it's kind of hard to tell the difference. Um, let's go put it back to maybe 5. What's 5 look like? Yeah, then you can see the line color better. Okay. Put an outline on the chart. So this is cool. We've got the total units we purchased over time, total actually available to rent, and what's the resulting revenue. We'll put access titles here. So this is units purchased rentable, and this is revenue. Okay, that's a good one. And these are bigger, so we're just going to stack them below each other. Next chart. What do we want to do? Maybe we'll show the percentage of utilization average over time. In this case, it's 75% because I just hard coded it for every single one. But let's say we start at like 10%, and these can be different obviously for each category, but let's just say we start at 10, and then we go to like 25, and this is essentially saying you're getting more popular, so whatever you have available to rent, you're just able to rent more of it. It's like kind of a occupancy. And then let's say we get up to 70, 85. And then let's say these are going to be a little bit better. Do 20 on these. 90, just so you can see how it averages it. So if those are that, you go to visualization. Now you can see the averages over time. And these are just marks you're trying to target. These are good to target, like, okay, what am I trying to get to in 3 years as far as my utilization of what I'm renting out. Rentable units. And I like the term units, and really this is going to be a general product rental model, and you can rent, or honestly it could be like a tangible good rental model. I'm trying to think of the most broad term to use because it really is why, like, it's not just equipment rental or party planning or party rental. Like, you could do anything here. Okay, average utilization of rentable units. We've got revenue and Ebitda and stuff over here, so I'm not really worried about those. We definitely can do cost. And oh, here we can do. We can definitely do revenue by category. That'll be a good one. And this will be a different type of chart. So if we do on the annual, there's so many here. I want to do this. So we can definitely do rentable units by category as one chart. We can do revenue by category as another stack chart. Let me see, switch this. And actually, I don't want any of this. Remove, remove, remove. Here we go. So this should have all my categories. And then I want to change this into a stacked column. So it's kind of cool. So you can see by category, what is my rentable units by category over time. And let's make sure this is rentable. Yes. So this is after taking into account the degradation. So that's a cool one. And then we can see here the difference between what we bought and what's actually available. So that's already there. Rentable units. Let's do. So remove all of this. Do the same exact thing, but now we do units fully rented out. So this could tell you, this should show you granulation between availability to rent and actually rented per type, because some types might be more, even though you don't have as many, you might rent more of them out if you think, and this might be good to explain. All right, change, what are we doing here? Select, switch this, and we actually got to uncheck all of this. First set of categories. We don't want to see any of that. We just want to see. I mean, I don't. What would be cool, and I don't think Excel can do this, is if I could show the stack column of rentable, and then next to it show the stack column of actually rented. But I don't think it can do that. That would be cool though. Get all this out of here. All right, now units fully rented out. That's what we want, 1 through 25. Okay. And oh, we don't really need year 0. Oh, no, 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 hold on. Shoot. This is by year. Okay. Here again, we don't need year 0. And that worked fine. That's how it should have worked, the first one. So, actual units rented. I don't know why the access isn't looking with the comma, but we'll just put it in there. Wait, link to source. Oh, here we go. Number. Perfect. Same thing here. Number. All right, so we've got revenue versus units purchased. average utilization, rental units by category, rentable units, actual units rented. So you can see this goes up about 3,600, but we actually only rent about 3,300 or so. So that's really, these charts should be side by side, but it's okay. All right, so that's cool. What else do we want to do? Oh, obviously, revenue by category is a big one. So let's do same thing here, but let's get, how far do we got to go down for that? To 95. Okay, so select data, go down to 95. And just so you guys know, you two viewers out there, I'm planning on switching my times to stream to Monday evenings at like 5 Eastern instead of Tuesday mornings for a bunch of reasons, but just note that. Okay, so let's see if we can get this right. Okay. Oh, it's actually easier just to remove. So there's those. Rentable units. We don't need that. Okay, now here is revenue. Revenue by category. And these should be in dollars now. Okay, so make sure this is almost 3 million. Is that correct? Yep, 29213 300. Perfect. So you can see the total revenue, and then the granulation shows you how much revenue you're getting from each category within that total. Okay, that's a cool one. What else do we got here? We can do, so one that is another nice one for stacked. We don't need all this though. Is expenses by high level category. And this one we can just go to the executive summary and go G&A is one, sales and marketing, research and development, and then we have the other. Okay, so this is, let's see, that looks kind of crazy. Expenses by category. Change the color of this. Give these outlines. All right, like this. I don't like this color though. Can we do like, yeah, like a light? There we go. Maybe this can be gray. Okay. What else do we got? Expenses by category. Oh, what was that one monthly? So this was interesting. The average monthly rentable revenue per unit rented and available. So both of these are cool. I think those are going to be line charts. The hardest part is getting all the data. The visualizations are really just a product of how cool your data results are. Okay, that's a good one. And then actual what you're earning for the units rented out. We're also going to put some cash flow stuff in here. All right, so that's the same because I think all these at $3. Let's say this is like 1, 2, 3. Just put some different numbers in here. There we go. Now, yeah, we should be getting some different stuff here. So you can see average rental revenue per month available versus available to rent versus rented. So the smaller number is based on all the units you have that are rentable, and that's because, well, if you're making X dollars on 100 units in inventory, that number is less than if you're making X dollars on actually 80 units that were rented out. So this is another function of this here with utilization. Okay, let's do cash flow real quick here. So usually with this, how do I want to do this? I think we actually need to add cash flow after equity. Well, we can do so let's do a couple. We can do cash flow before equity, which is going to give you your most negative cash position, and then cash flow after equity is going to give you, basically it'll show you how you get down to 0, and then you don't go below 0 though. So it's going to be the total cash flow accumulated plus any equity contributed, which is, we're assuming it's this. And then from there, it's just the same exact calculation. So now we should see a number getting to 0 and then going up, which we do. I'm assuming here, there it is, there's the 0. And we could put that into the annual tab as well if you want to see it there. And you won't see a 0 here because this is on an annual granularity, which is just different than the monthly. The monthly is more accurate, obviously, if you get really far down on a monthly basis, but for the year you actually didn't get that far, well, you still need to know how far you got down on a monthly basis because you're going to need that to cover that burn somehow. All right, so the difference between these two is just the equity contributed, which is this 38,476. Let me just make sure that matches. Yeah, 38,476,770. All right, we're making progress here. So now in the visualization, I can do the actual monthly cash flow, which is another. So this is what you're doing each. We'll include year 0 here too. Each monthly period. And then you also have the accumulation of that. So this chart is showing what happens before equity. And put this below so you can see a little bit better. And it's hard to see with the exit value. Let's just put this to NA for now. And there you can see a little bit better. So you can see this color line, which I want to make a different color. Why can't I make this black? Make the whole line color black. What the heck? There we go. So the black line is your accumulation of the project cash flow. So if it goes negative, that's how much equity is needed. Then this you can barely see because it's. Let's actually put this on a bar chart. The cash flow per month is just really small compared to the accumulation of it. I don't want to put it on a different axis though, so let's just do a copy of it and just show, like, here's your literal cash flow per month. So you can really see, and then the orange is the accumulation of that. So you can see it starts to go, you basically break even here somewhere around March 2022. You start to make a profit every month based on the assumptions. That should be centered. So we've got monthly cash flow, average rental revenue. Oh, this is monthly cash flow versus all right. Do we have any other cool stats we can put into here? Sure, I guess net book value. That's going to be all purchases less accumulated depreciation. Net book value. And then once I finish these, all I have to do is really put an index page in, and then that's going to be the whole model. Net book value. Did I stop at E? Yes. Net book value of rentable units. Total. Give this angle. Let's see. Anything else that's interesting? So we have distributions breakdown. We have revenues, income. Then we've got all this fun stuff here. Spent by category. Maybe we can add like an expense by category percentage. So on this one we could do same chart, but let's make it a percentage of the total. So now each year you can see the percentage. Expenses by category, percentage of total. And you can see how over time the other is getting bigger because it's just a percentage of revenues and revenues are growing. But we start off with sales and marketing being more, and then it goes down. Yeah, I think that's a good one. Keep that. We can also do the same thing with revenue. Oh wait, yeah, this is where's our revenue? This one, especially if you have some bigger items, you want to see like where you're getting most of your revenue from. And if you don't do all 20 some categories, this could also be very helpful. We do a percentage on this one as well. And we don't need year 0. Percentage of total. And then this is stacked. We don't even need to say that. Now it's getting smaller, I think, because we have, what do we, oh, yes, because we have some things not starting until later. So the percentages are, that will be a function of this though, or this is going to drive like the timing of when these are things are purchased to be rented out. It's going to drive like this breakdown, as well as obviously the rentable units and the rent rate per category. All right, so we got a lot of visuals here. Just trying to see if there's anything else that really would make sense to put. We could do Ebitda. So we did Ebitda net income by year. We can do it by month. And just do, let's do Ebitda. Now this would also be interesting to put against like total purchases. Maybe. This is Ebitda. Just formatting this. This needs to be 30. Always got to be consistent with everything. Okay, so that looks nice. Rental revenue, monthly cash flow versus accumulated cash, monthly cash flow, net book value, Ebitda. Yeah, Ebitda would be nice on this. I mean, we could probably add it maybe. Let's see what it looks like. it's got to be on the Ebitda. Wait, it's on the secondary. It should not be higher than. Oh, whoops. Hold on. So cumulative purchases. Oh, okay. So yeah, uncheck that. Okay, that makes sense. It should be here, and then I hate this line color, but we might actually have to have something like that. Put the markers in here. 5 diamond. We'll do fill the same type thing. Yep, that's fine, I guess. So Ebitda. This is now revenue slash Ebitda. Oh wait a second. Revenue is a bar. Dang it. I mean, I guess we could. So EBIT is always going to be lower than the revenue, obviously. I just don't want this line to get confused with the purchases in rentable units. What does it look like if we make it a clustered column? Oh yeah, that's fine. So you can kind of see the shadow of the revenue is your EBITDA. Perfect. That's better. And yeah, I guess that works. Revenue versus EBITDA, and then you can see how your purchases over time are increasing that for scale. Revenue and EBITDA. All right. I mean, we're getting there. I don't know what else I really need to add. Revenue, Opex, all this. So next up, I'll probably just do a video, a 10-minute overview of the whole model, and then upload it, and we're going to be done. Oh, let's do a quick XLS check. So this is to make sure I don't have any references anywhere in the workbook to other workbooks. I go to find and replace, type .xls, and do within workbook and hit find all. That tells me if I have any references in here that should not be. Okay. Let's freeze this real quick. I think we're good. I'm gonna upload this. We'll be on something else next week. I don't know what, but cranking them out. See you guys. Now, remember next Monday around 5. Monday at 5 is when I'm gonna start streaming instead of Tuesday mornings.